Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. I'm once again joined with my good friend Doug Heagren. Hey, Doug.
Hey Kirk, good morning. How you doing today?
Doing great. Doing great. Just got back from vacation, and as you might imagine, my first week back was it was twice as bad as the week before I left. So it makes you wonder if you should go on vacation nowadays.
Well, see, I tell you, I'm feeling as optimistic as a millennial day trader. I mean, life is good right now.
Just as naive.
What are you talking about, Kirk? Maybe we should address that today.
maybe maybe we will. All right, well let's dive right in. We've got lots of stuff to talk about, as you might imagine. There were tons of earnings this week, both good and bad. Um, but one thing I wanted to talk about as we start off here, before we get into kind of like earnings and all that, I wanted to get into, as you might imagine, the economy and housing. And I want to start with this chart here because I think it's really interesting. We've shown this on the show before. There's a chart which we call the Hope chart, and we didn't create it. I forget the guy's name who did, but basically the Hope chart talks about recessions. Now, we had big earnings week, and inevitably people are talking about where's this recession? Where's the recession everyone's been talking about for like the last year and a half? Where is it? Is it coming tomorrow? Is it coming next year? Did it already happen? People seem really confused by this. And I think what's interesting is that in the past, 2008, for an example, or early 2000s as another example, those are the most recent recessions that we recall. And I'm not including 2020 because that was a little bit different. But even if you include that, people assume a recession means the stock market's going to crash, everything's going to go to zero, people are going to be jumping out windows, it's the end of the world as we know it. Dogs and cats living together, it's crazy, right? So what really happens in a recession is none of that. Those are not recessions, those are crashes. Crashes can cause a recession. A recession could be inevitable, but a crash is not the cause of recession. But because that is the most recent example or examples that we've seen, we naturally think that's the case. Because if you haven't been, I've been doing this for 24 years, I've seen a lot, but I haven't seen prior to 2000, or I have in history, but not like live. And, unless you're like 70 years old, you probably haven't seen a lot, right? If, there are a whole generation of people who are in the market who have barely seen a crash, right? They didn't see 2000 because that was a long time ago. Some of them may have seen 2008, but the biggest thing they saw was 2020. None of those things are quote unquote normal, right? Normal is what we saw in the 70s. Normal is most likely what we're going to see now. And I can't rule out a crash, right? Because who knows what's going to happen? Maybe some single bank implodes and it causes the whole system to implode. I don't know what's going to happen. But excluding some event like that, what's probably going to happen is what has been talked about in the Hope chart, which we have shared in the show in the past, probably about a year ago now. And now people are starting to talk about it. Once again, Doug, we're ahead of the curve. So this Hope chart, I want to kind of talk about it. And what this means is there's an order to a recession. Okay. Now, the order is in the order of hope. So let me spell it out for you. Hope starts with H, housing, then O is orders, P as in profits, and E as in employment. So in a normal recession, there's a peak first in housing. Well, as we saw in November 2020, there was a peak in housing. That's when housing peaked, okay, according to the NAHB. Orders peaked in March of 2021, okay? That's when orders peaked, and they've gone down since. Profits more or less peaked in June of 2022. That's when profits peaked. And then the last one is employment. Well, when did employment, quote unquote, peak? I don't really know at the moment because employment has basically flatlined. One could speculate that it was somewhere around earlier this year, but as you can see from the chart, it's basically flatlined. So until it starts to pick up, we can't really see where it peaked. But at the moment, we're still waiting for employment to or unemployment rates to start to head up. And I think that's really the point here is that while people are getting laid off, right? There are a bunch of companies. 3M, I think, laid off a ton of people this week, and that's not a tech company, Doug, is it? Is 3M a tech company now? Everybody's a tech company now.
There's a saying, there's three M's, and they don't stand for certain things. Well, there's no T in it. It's definitely not a tech company.
So if you think about, the companies that are reported and the results that they've provided, tech companies have gotten, basically taken out to the woodshed in the last 12 to 18 months. Okay. And that's normal, right? Interest rates go up. It's not good for tech. I think tech was overvalued anyway, but anyway, people decided it was time to take it out to the woodshed. But the rest of the economy didn't have the same effect. Now it's starting to show up a little bit in other parts of the economy. But I think we're all accustomed to a crash. And when you don't have a crash, you're like, what happened? Are we in a recession? Well, you could, according to the Biden administration, we're not in a recession because they recharacterized what a recession is. They decided it was something different. Well, in some hands, I'd say, well, that's politics. You're just basically renaming things that suit your fancy. But on the other hand, in some ways, it's kind of correct. And the reason I say that is because, this recession is not typical of the last 20 years, which is what most people remember. And because employment has largely remained pretty high. And at some point, that's going to start to tail off because companies are going to have to start to cut costs. A lot of them are already pretty skinny anyway, but they're going to have to start cutting costs, which means employment. And I have a few friends that work at big Fortune 500 companies, and they laid off a ton of people, and they're probably going to have to go through other rounds in the subsequent months. So the whole point of the HOPE chart is to show where we are in the recessionary path. Now, before I hand it off to Doug, I do want to point out that we started talking about this a few years ago, but the concept of stagflation, we started talking about it well before everybody else. Stagflation hasn't hit yet, but it's hard to imagine that it won't, because effectively what stagflation is we have an economy that's stagnant or flat or declining, but let's say it's flat, right? It's not growing. And you have high inflation. Now, what that means from an economic standpoint is you have high inflation, which means that the price of things are going up in relation to your money, right? So your money is basically getting devalued. So inflation's 5%, and you have $100. It means next year your $100 will be able to buy $95 of the same stuff. That's effectively what inflation is. Now, as long as inflation is similar to the growth of the economy, then everything's okay. The problem is when that doesn't happen. So right now, the growth of the economy is pretty flat, and the inflation is 5%, right? And it was up to 8%. So it's still higher than the growth of the economy, which means that people are going to lose money overall. And so if you don't have the growth, let's say we have zero growth and we have inflation of 5 or 6%, then everyone's going to lose money of 5 or 6% every single year. That's a bit of a problem. So stagflation is a big problem. It was in the 70s. We talk a lot about the 70s in the show. The 70s are a great thing to study if you want to know what's happening, what's probably going to happen. And, so we haven't hit stagflation yet, but it's coming. The only thing to stop stagflation is inflation goes down to like 2 or 1% and stays there. We talked about last week how inflation, Rob Arnott from Research Affiliates talks about how inflation will go down to 2.7 and then back up to about 5.5 by the end of the year. We talked about in the show, it could go to 0. We were a little off maybe, but we'll see. Still early. So inflation's probably still going to go down, but at some point it's going to go back up. So I wanted to start the conversations there because I think people need to get some perspective when they start hearing all these things. Stagflation's scary, right? Earnings are great or whatever people are hearing. It's a micro speck in the grand scope of the economy. And today's news is great. Tomorrow's news is terrible. The next day's is great. The day after that's terrible. You got to get out of the news cycle. Don't get triggered by the news. The news is not going to tell you anything useful. Earnings, good, bad, who cares, right? It's what are the stock prices doing? What's the market doing? What's the economy doing? What's unemployment doing? What are profits doing? What are orders doing? I mean, all these things are really important. That's why we talk about housing so much, because housing is a huge impact on the economy, because that's where people's wealth are stored for the most part. And if wealth is getting destroyed, that impacts everybody, right? You can no longer use a house as a ATM machine. People's credit card debt is skyrocketing, which we'll talk about here a little bit later. And that's a big problem, because at some point you run out of debt, and that debt is paying approximately 24.5% on average on their credit card debt. That's ridiculous. Who in their right mind would pay 24.5% on credit card debt? Well, people can't afford to pay any other way. Why would I pay 24%? I mean, to me, that's ridiculous. I would happily pay that off and sell my portfolio to pay that off, because in essence, I'm not going to be making 24.5% on a portfolio consistently. So I would pay off that debt. But I think it's important just to keep all these things in context, because in a small scale, looking at today, you think, oh, everything's rosy, tech's going up, we're doing great. Is that going to last? Probably not. And I think that's the thing I want to bring up. So, Doug, what are some of your thoughts about this?
I want to go back to the last thing first. My short-term memory will only keep me so focused on it. Just kidding. But you're talking about the credit card debt, and I think I think people need to put into perspective what this means. A 24% interest rate. I mean, this is borderline predatory rates at this point. It used to be that was unheard of without legal action. A typical credit card is going to charge somewhere around 2% of the balance per month as a minimum fee. Okay. So if you would take a $10,000 credit card limit and you've got a 2% minimum fee, well, that's or a minimum monthly payment. That's going to be $200. $200 times 12 is $2,400. Here's the problem. When you start getting into 24 and 25% interest rates, that's a quarter of your balance in interest per year. So if you have a $10,000 interest rate, you're going to have $2,500 in interest per year. Remember what I said, the average minimum payment is calculated about 2% of the balance, which means that the minimum payments under historic calculations cannot even cover the interest due on that type of a credit card. And that leads to countless problems. The first problem being, it is generally just going to be hard to pay it off, right? Because you've got all that money going to interest. But the second problem that you're going to run into is that now the minimum payment's going to go up. If you were already stretched on cash flow, because a credit card is not an interest-only card, right, Kirk? It's not an amortized card. They haven't figured out how to calculate it into a wonderful payoff cycle. If it did, it'd be like a car payment and be done in 5 years. But if you ever look at your statement and you see that if you pay the minimum on this, this is when you'll pay it off. You'll note that it is not designed by any means to have a fixed payoff schedule. So if you are paying on this and it is a $2,500 annual interest rate or $200 a month, your normal minimum is now interest. They're going to have to tack principal on top of that. There is some principal that they want back, as minute as that may be. What does that mean? It means your minimum payment just went up to not from 2% to maybe 3% to 4% to 5%. If you're carrying debt, you don't have the cash flow. You've already proven you don't have the cash flow anyway to cover your average expenses. We've already got inflation going up in the areas of everyday stuff. So let's take a look at utilities, right? My utility bill is double what it was a couple years ago. Now you come back and you not only have inflation on your everyday goods and services, which you already are having trouble covering, now you're getting inflation on your debt service payments. Okay. So in that regard, if you were to say, well, yeah, I don't want to use my home equity because I want to pay that debt. Listen, if home equity has gone up, it's not going to cost you the same as it was 2 years ago to tap into it. But this might be one of those situations, say, look, it makes sense. Go out and get a home equity loan. Maybe it's 7%. It's better than 25. And at least now it is a fixed payment, which is a declining payment against inflation. This is this is a serious problem that we're running into, because as Kirk is showing on these consumer loans, with the amount of billions of dollars of credit cards that are going up there, majority of people that is rising on did not have the ability to cover their average cost as it was. Now you get into increasing payment costs. It is a downward spiral. Let's go back now to the hope chart, because the hope chart, and you were trying to reference this. The gentleman that's behind this is Michael Kantrowitz, CFA. Michael puts out some incredible stuff, and what he's showing here is that, and this is something I think there's a massive level of complacency that's going on. I watch and listen to the rhetoric that's being broadcast publicly, and I'm hearing this. This isn't the same. Housing market isn't the same. You hear the same old things like, well, everybody needs a home. We need more homes. Well, yeah, we do, but we are also just below the peak of the inflation adjusted most expensive housing of all time. And then we took and we reduced the liquidity and access of money to those that are trying to get those homes. So they may need homes, they aren't out there. Okay. And they can't afford what is out there. And that forces people emotionally to make a decision to buy something that they can't afford. And then let's talk about all the other costs that go into it. If you think that your cost of your house is going to be the mortgage payment, and we know this, Kirk, people compare the rent to mortgage. But are you comparing all the other costs going in? If you just rent, that's all you got. You got your monthly rent, maybe your utilities will be tapped on. If you've got your mortgage, you've got your property taxes. Now that might be built into your payment already, but those things change. I mean, we've had spikes in taxes and spikes in insurance that have led to a change in your payment on your housing because the escrow is tied to it. Escrow is not fixed. Okay, it's an estimate. Now you got to add on landscaping. You got to add on maintenance. You got to add on rising utilities. You've got to add on, all of these other variables that go on to being a homeowner, furnishings and things like that. Okay, so it's not apples to apples, but I hear this. This apples to apples of what a mortgage payment costs versus rent. You go, and now you also see people talk about the stock market. Well, see, the stock market doesn't care. This is different this time. It's not going down. Listen, we haven't had the shocks to the system. And I think that's the issue that we're facing right now is that the system, again, we've talked about this ad nauseum, Kirk. The stock market reacts to surprises. Okay? We haven't had any surprises recently that have caused the market to do anything. But one of the things that has been talked about is the strong jobs market, the strong earnings market. Well, the earnings market has started to decline. The jobs reports are coming out and they're not as rosy as they were either. Let's go back to the credit cards. Okay. People are struggling to cover their bills. The M2 money supply has been rapidly reabsorbed. We're still sitting on tons of cash out there. But I'll tell you, Kirk, who's got the cash? The wealthiest of the wealthiest. They haven't spent it down yet. They already had the assets. The bottom of the economy, the bottom of the economic scale, the bottom earners, they don't have that cash. They spent that cash. They used that cash. They tried paying out debt. It's not there anymore. Now they're rising credit cards. Now their payments are going up in all those areas. And let's put the last spark, Kirk. What happens if you're servicing all that debt and you lose your job? Well, bankruptcy. And guess what? We've got student loan problems. We got credit card problems. Bankruptcy does not help with student loans. But on top of that, all of a sudden, all of these homes that nobody was going to get rid of because they've paid them off, or they need a home, all of a sudden, guess what? We're starting to see mortgage payments. We're starting to see that people are falling behind on those too. And guess what that leads to? That leads to supply. That leads to sales. Sales that, yes, economically speaking, probably aren't going to happen. But we are entering the E part of hope. And because of that, if we start to look at what could potentially happen over the next 6 to 12 months, the reason, the fact that this won't happen again. Listen, one of the things I want to transition to, and I'll let you talk about this, Kirk, because I've hijacked, but we have a chart on this. And I'll give Michael the same credit on that one too. It's his chart. What is a hard landing versus soft? There's a lot of people talking about a soft landing. Look, we're coming out of the recession. It's already improving. We might have seen the worst of it. I'd like to talk about what a hard land, what are the catalysts for a economic hard landing versus a soft landing. And maybe you could put this chart up here, Kirk, and let's see if we see any patterns here. because as far as I see from it, I don't feel that the rhetoric and the sentiment reflects what is typically the case. I mean, we've seen, okay, this is great. Let's look at the articles here. It's always been a soft landing at first. You always hear that every single time. 2008 was a soft landing. The 70s were a soft landing. 1980 was a soft landing. The end of the dot-coms was a soft landing. All of these things constantly. They never predict the worst, do they, Kirk?
I haven't seen one.
Only the perma bears do, and unfortunately, what shoots the perma bears in the foot is they are always bearish, even in a good economy. I mean, unfortunately, the sentiment and the rhetoric that is normally published out there, they double down. And again, we've talked about this too. There are studies that show the higher your degree, the higher your academic standing, the more likely you're going to be unwilling to admit your mistake, and the more you're going to double down on what you believe to prove your point. And so since we know there are more bulls than bears out there, 90% of the people out there are bulls, 10% are bears. When it comes down to predicting there's ever going to be any pain in the economy, they're going to double, triple, and quadruple down on the rhetoric that, listen, soft landing, this time's different, everything's good. But what's the reality? Let's go ahead and take a look, and we see that, again, repeated over time. These are real times that there was not a soft landing. But they're saying it again. But let's look at what really leads to a soft landing. Okay. And that comes from three very, very distinct variables that have repeated themselves time and time again. Precursors to a soft landing. A soft landing is low inflation. Kirk, do we have low inflation?
Not last time I looked, Doug.
Okay. Modest federal rates. Has the Federal Reserve been modest about their rate hikes?
Nope.
How about easing bank lending standards? Lots of free money being injected into the economy, easy to get to. How about that as well?
Well, to be fair, no, up until the bank failures a month ago. That was a secret bailout, but yes, it is still tightening.
It's still tight, exactly. So in all, I mean, but these banks truly, we came down to let's face it. Let's look at what a soft landing was. Let's go back 5-10 years ago. Low inflation, modest Fed hikes, easing bank lending standards. Well, no wonder we had a soft landing after COVID, right? Because everything collapsed and then money came flush into the system. Inflation was low leading into it, and the Fed thought it was transitory. Well, let's take a look at the other side. Rapid Fed hikes. Kirk, have you seen those before?
70s.
Have you seen them recently?
Well, yeah, it's what happened last year.
That's what we're happening right now. How about inflation problems? Do we have any inflation that has all of a sudden crept in?
Yeah. I think we've had quite a bit, Doug.
Oh, and one last one I'll throw at you: tight bank lending standards. Making it a little bit hard, whether it's imposed by regulation or the banks are just afraid to do so. Do you believe that there might be some tight bank lending standards happening?
Well, I'll elaborate on that a little bit. Yes, but that's been the case since 2010, when after 2008 with the blow up in the real estate market, they instituted much tight lending standards, and so much so that banks really just aren't lending. So yes.
And actually, Kirk, that's a great segue, because I think that's one of those areas where might help us in the system. Because again, what are people saying about the housing market? They're saying that in 2008, there were so many bad mortgages out there. It was an incredible amount of bad debt and low grade debt. And ultimately, it was all packaged into the system. Nobody knew where it was. And we ended up with basically a credit recession, right? And ever since then, the banks have not lent near to the standards that they did until COVID and until the lending standards went to zero. And look what's happened in just 2 years since then. We've had a bunch of bank failures. So shocking. But up until that point, banks have really been much more restrictive. It's been harder to get money over the last 10 to 15 years. And that may have actually slowed down what could have been an even worse housing appreciation, value appreciation problem, an even worse situation of bad debt. That might help us a little bit. But other than that, the three catalysts there tend to lead to sharp deterioration in employment. And over the last 60 days, we're starting to see it. As you talked about, the tech, they went through and did significant tech downsizing, and there's more to come. And they've had a little bit of a rebound there economically, and that's helped the stock prices, and that's going to slow things down. But that may not last because, as I said before, tech is driven off advertising, and it's driven off of a cost center of corporations. Corporations invest in tech with money that they have as a surplus to create efficiency. It's not a revenue producer. Okay, so it's generally an area that tends to be downsized in tighter economies. But the other thing is we're starting to see it like in the manufacturing sector. There's a number of companies that have started to announce layoffs. Again, we talked about 3M. Almost 10% of their workforce has been announced to be downsized since the beginning of the year. Okay, so we're starting to see that, and these are people with real credit cards, real mortgages, real utility bills, real student loan and college savings. This is when there becomes a spark and a rippling effect that comes out of that spark. There's your bullwhip to the shock reaction. And at that point, all of a sudden, then you start to see, oh, wait a second, this isn't what we were expecting because everybody's been a little downgrading on it. What comes next? Markets.
Yeah, I think unfortunately we talked about this a year ago. One of the aspects of a bear market is it's confusing. It's described as mass confusion, which people might think, well, mass hysteria, mass craziness. No, mass confusion is no one really knows what's going on. And the reason they don't know what's going on is because there are no solid trends. There are a lot of factors going into play that change the dynamics. So we've had a huge bull market since 2009. We had certain periods that are trendy, right? From 2000 to 2003, it was a down market. 2003 to 2007 was a bull market. Then obviously the market crashed. 2009 until 2021. Like, we had periods where things trended and they were easy. You can buy and hold, buy and hope, whatever you want to call it. You could do that and be relatively successful. The problem is in the 70s, it was not necessarily like that. There was mass confusion because there were a lot of inputs that were unpredictable. So you had the oil crisis in the 70s, which you had gas lines, you had all of that, which isn't technically happening now, but you still have international issues that are effectively going to affect oil at some point. You have an administration that is anti-oil and is effectively going to cause a spike in oil prices. I know people say, well, you don't bring politics into it. I generally don't like to, but we've talked about it a bunch on the show. Having negative policy around oil, all that's going to do is hurt poor people. And they're going to come out and say, well, we're trying to protect the poor and we're trying to protect our constituents. No. What they're trying to do is they're trying to make energy more expensive, so you consider the alternatives. Now, we could debate all you want or whether that's a good idea or not, right? I'm not going to sit here and judge whether that strategy of making cheap energy more expensive to make the cleaner energy cheaper, we can argue whether that's a good idea. My side is no. I think that's stupid because economically, that's not a free market. That's not how free markets work. The way you incentivize people is the opposite. You don't make cheap stuff more expensive. You make the more expensive stuff cheaper, right? Which is what they did, right? They gave tax credits for electric cars. They gave tax credits for solar energy. All of that stuff I agree with. That is good. If you're trying to influence policy for people's decisions, those are good things to do. But if you're trying to do the opposite of make cheap energy more expensive, there's a correlation, and you could argue whether there's a causation, but we talk a lot about in the show about correlation versus causation. So I'm not going to make the misstep of saying it's a causation, but a very high correlation of this. If you look back hundreds, if not thousands of years, there's one thing that rings true. The peaks of civilization, the efficiency of markets and economies, the boom times center around cheap energy. You go back hundreds of years. When did the massive amount of growth start in this country? When they discovered oil and became cheap, right? I mean, up until 2000, I think you could get like gas for under $1. Like it was really cheap, right? And that was like the boom times. Now things are more expensive, right? But if you look at it from like a large scale, anytime there was cheap, abundant energy, that's when you had a boom. That's when you had abundance. That's when you had growth in the economy. That's when you had technological innovations, because you're not spending all of your money and your resources to heat your home, to light your, to put energy into your house, to drive your car. All of these things are based on cheap energy. If you have cheap energy, then you don't focus on those basic essentials. Then you focus on other things that matter. But when it costs $20 a gallon to fill your car, you're not focused on, hey, how can I solve the world's problems? You're focused on, how can I get to work? How can I pick up my kids? Do I have to take the bus? Like there are a lot of challenges that all of a sudden come into play when you make energy more expensive. And it's just like having food being expensive. Food is an essential part of living. If you can't pay for food, you're not going to live very long. If you talk about the hierarchy of needs, food is one of those baser essentials. If you can't eat, you can't do anything else. So when you're worried about your food, getting enough of it, I mean, my dad grew up in the Great Depression, so I heard all the stories. He couldn't, his family didn't make enough to feed themselves. Many nights, his mother would do what we call now intermittent fasting, where she would give him her hamburger because she wanted him to have it instead of her because he was hungry, and she said, "Oh, I'm not hungry," and just gave it to him. Reflecting on it, he's like, "Well, that was a very nice thing to do as a mother." But at the time, of course, growing boys, I got boys too. They're growing; they need lots to eat. But the point is they didn't have enough for everybody to eat. That was the Great Depression. That was not a good time. That's when people legitimately were worried about where they were going to live and if they had enough money to pay rent and did they have enough money to feed themselves. Those were not good times, right? People were not inventing new things in the Great Depression. They invented a lot of new things in boom times, right? You think of like the innovation going on in technology and biotech and the med space, like all these things are happening because people are not worried about feeding themselves and filling their gas tank. Cheap energy is important. There needs to be cheap energy. You can make it cheaper. You can make clean energy cheaper in other ways. That I fully support. If you want government dollars to do that, to support that, totally in favor of that. This is not an indictment of the clean energy movement, right? Although I do have some critiques there. It's not an indictment of that. I think it's great. I think we should all live in a clean world. I don't think there's a person on the planet who thinks, I really want to live in a dirty planet. Nobody thinks that. And if you think that, then you're having cognitive dissonance. Nobody thinks that. People address it differently. People think the way to solve it is different, maybe from other people. That is a truism, right? Some people might think, well, we need to do it this way, and other people think they need to do it that way, and they argue and they say, well, you're an idiot because you think the world's going to end. It's like that's not what I think. That's how our society operates now. People are imagining what the other side thinks. What I'm saying is it's really simple. If you want to make clean energy cheaper, do it. Don't make dirty energy more expensive. That is a stupid way to get to your goal. And all it's going to do is destroy the economy long term. And we're going to end up like Venezuela or some of those other countries that basically, destroyed their energy industry. And now they can't even afford to pump their oil out of the ground. Love to see a cleaner future, but it's not going to happen tomorrow. It's going to take years and years for that to happen. And until then, I don't really want to suffer. I don't want to have to pay 5 times as much to fill my gas tank just because somebody in politics decided it's a good idea, right? There are many ways to solve this problem. And I think if we get the idiots out of politics, we probably wouldn't have anybody in politics. But if we get them out of there and have maybe some really intelligent people making decisions, that might help. But I don't think that's ever going to happen, unfortunately. So
there's an old say, well, a newer saying, Kirk, that unfortunately with today's social media and character assassination that nobody that is actually good enough to run for politics will ever be willing to run for politics.
Right. What's that? I forget the guy's name. Old guy. He said, "I never want to be a part of a club that'll have me." It's the same thing. Nobody wants to run for
Carlin?
politics.
That sounds like Carlin.
No, that's not Carlin. That's maybe Chaplin. It was like an old comedian from like way back. But basically, I probably misquoted it, so I apologize for the older people listening to this who probably know the name. But the point was, I'll never be a part of a club that will have me as a member. And the point is the same for politics, right? Nobody in their right mind would run for politics. I mean, I would love to help and make the world a better place, but I would never put myself or my family or anybody I knew through that. It's just the only people who do it, I have to say, are probably sociopaths. You could say your party's right and the other party's wrong, but I think they're all sociopaths at some level, because otherwise you wouldn't do it. Like it's just a terrible existence to see what's happened in the last 8 years. So
you nailed it. You nailed it, Kirk. It's Groucho Marx, actually.
Yes, Groucho Marx. There we go.
You nailed it.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
But anyway, so I do want to point out we've definitely had earnings season, and big tech has started to pull it out. I wanted to show these. There's some really good charts here that you sent me here, Doug, and let's see if I can show them here on the show. If you can find these, they're brilliant. Just because it takes, I will say this: nobody wants to look at fundamentals because they're boring. They're numbers and they have no relevance. They're like, I don't understand. How does all this stuff work? Well, here's a visual. All right, this is looking at Alphabet, and I don't like looking at single companies, so I'm going to pull a few of these up there. But the point is what this chart shows, and it's done by Genuine Impact, but I think a bunch of people have done these, and they're really brilliant way to educate people on earnings, right? So what it does is it breaks down the revenue. So it looks for Alphabet. So it looks at the search advertising. It looks at YouTube. It looks at what does it say? Ad mob, whatever that is. I don't know what that is. Google Play, Google Cloud. So it looks at all those as revenue streams. Okay. And then it breaks down, all right, what are the costs, right? So it looks in what are the cost of revenues. So the full revenues are 69.7 billion. The cost is 31 billion, and the gross profit is 39 billion, right? And change. And then it breaks it down into all different areas. So operating profit, operating expenses. It's really a great way. So if you're listening to the show, I highly recommend you go to YouTube. I highly recommend you go to LinkedIn and see this live, where we show you the visuals. Go on our website. We have the visuals there. It's a really great way to understand how the financials of a company works. I'm going to show you another one because I love these things. It's like it's really, really fun to watch. Here's another one for Amazon. So here's Amazon's chart. So it looks at products and service of North America. It looks at international and AWS. So it just kind of, it just throws everything in a bucket. So you can see how much of the revenue is coming in for each area, and it throws into one big revenue bucket. So you can't see necessarily the gross profit for each area, but it does at least show you the amount. And I think it's really interesting. So you can see in this area, AWS, which is the cloud, is 19.7 billion. The total revenue is 121 billion. So it's a small piece of it, but obviously it's profitable. You have another one here, which we looked at, Alphabet. Here's one for Apple. It just shows the amount of revenue that goes in the iPhone, the iMac, the iPad, the Apple Watch, Apple Pay. So it's a really nice way to look at how much of the business is coming from these things. Now, I'm going to stick on Apple for a second because, looking at Apple, one of the big challenges that I see for Apple is not the iMac, it's not the iPad, it's not the watch, it's not Apple Pay. It's the iPhone. So one of the challenges with the iPhone is it's a great tool, right? Everyone loves it. Everyone loves Apple. They think it's going to grow forever. And I'm cheap, so I try to make the most out of my phone, right? It should last for 2 years. I try to make it last for 4 to 6. And Apple doesn't like that, so they send me updates, and then they basically kill the battery life of my phone, and then they blame it on the battery, even though it's not the battery. They blame it on the battery, and there was a big lawsuit. And anyway, we won't go down that rabbit hole. I've had a lot of arguments with them in the store on this. But anyway, the point is now my phone costs me whatever, $1,500, $2,000. I don't even know because they've hidden it in the monthly payments. But it's gotten so expensive that they have to do a monthly payment plan. Otherwise, nobody would be able to afford it. And they're trying to hide it. And they're also trying to hide the fact that, they used to make them in China. They still do. But they're trying to outsource to other countries, which inevitably will be more expensive. The problem with the iPhone is not the quality. The quality is great. The problem is the cost. As the cost goes up and we get into a recession or stagflation, the price is going to stay the same, maybe even go up, but you're not going to make any more money, which means that you're not going to be able to afford it. And I don't mean you, the listeners, but I mean a lot of people in this country won't be able to afford it. So at some point they hit a level, and I'm sure they've figured this out because they've gone to the monthly payment mandatory model. So I'm sure they know what that number is, and they've already hit it. And at some point, that monthly model is going to become a problem. So the point I'm making is that a lot of these companies that you think are impermeable to a recession are going to hit a recessionary forces at some level, because at some point people just can't afford to buy things. And a phone is an essential part of the economy now. People look at a phone as essential as food and electricity and housing. Some people just can't imagine not having a phone. Doesn't mean you have to have an iPhone, right? You can have a Google phone. You could have whatever else is out there. I don't even know anymore. You can go get a BlackBerry if they still make them. But at the end of the day, just understand that all these companies will get affected. And just because they have good earnings doesn't mean that's going to last forever. And here's Microsoft. Microsoft also came out with great news. Their stock jumped a lot. Microsoft 360, which is their Office. They got Windows, and then they got their Azure platform. Total revenue 51.9 billion. Profits 35 billion. I mean, Microsoft is just a cash machine. I love, and I don't want to give advice on individual stocks, but they're just a cash machine. They always have been. I think the question isn't whether they're a cash machine, it's whether their executives can keep themselves from doing stupid things. Now, Nadella, I think he's done a great job as a CEO. Prior to that, Ballmer was just a disaster. And hedge fund managers I knew used to actually calculate into their calculations on Microsoft. We're gonna erase $5 billion because they're just going to light it on fire with stupid acquisitions. They legitimately would price in that they're going to light like $5 billion on fire every single year because of stupid acquisitions. And so I'm glad he moved on, and you got Nadella in there. He's done a much better job. He hasn't done a great job with LinkedIn, but everything else he's done has been great. So I really just want to point this out. So those are some of the charts. Highly recommend people look at them. Doug, what are some of your thoughts as we kind of get close to wrapping it up here?
Well, going back to some of these charts here, I love what you brought up with Apple, the phone. One of the things that Apple has been reliant on is the global middle class, the rise of global middle class. The iPhone was incredibly popular outside of the United States. I know for many people, maybe not people listening to this, but for many people in America, you might be a little confused to know that there is a world outside the United States. But this area is definitely where the rising middle class has occurred. And they're already starting to have cracks in that as the global economy is facing its own pressures. They've already had reports of individuals in these countries switching away from iPhones to other less costly, maybe locally produced, phones as an alternative. Again, it's a luxury. It's one of the most expensive phones in the world, and it's as cool as it is. At the end of the day, people just need to be able to access their data and communicate with those around them. And those premium type of things tend to go away when pennies get pinched. And you're taking a look here. The iMac's already been declining, and you talked about the iPad's kind of a mainstay. Another one that could be affected here is Google Pay, because as Google Pay is getting more involved in the transactional model. The transactional model is directly tied to the economy. If there's more transactions going on, and of course, if people are using the iPhone, they're going to use Apple Pay. If they stop using the iPhone, they may not use Apple Pay, or there just may be a general downturn in the amount of transactions that are run as we get into a more restricted global economy, right? It's natural. So I mean, because they're making, they can raise their transaction fees, but they are absolutely going to have, in that kind of a model, they could have a reduction in those types of number of transaction fees that are going to occur. Another one that I wanted to look at, you brought up, was Amazon. Amazon, again, it is a product of people having easy transactions and easy goods and services. The services side of it's more their AWS model, which is by far and away their most profitable arm. But one of the things that's going to be an impact on a company like Amazon, and they were already kind of feeling this, is fulfillment. Fulfillment is $20 billion in cost. And as you take, and tech and content is 18 billion. It is very expensive to store that technology. It's very expensive to expand the server capacity, and it's incredibly expensive to get those goods and services to you. It's the rising cost of not only the fact that Amazon has directly invested in their own broken down and beat up. It's always interesting. I can always tell, when the U.S. Postal Service is delivering a package versus Amazon, you see those broken down Amazon trucks coming to deliver them. But there's a cost to maintaining that fleet. So not only could, I guess in summary, not only could you see a reduction in the frontline revenue, but when you start to combine that with rising internal costs, then that is a catalyst for a significant shift in profitability. And again, where have these companies been? Why have they been the darling of Wall Street over the last decade or so? It has been both a combination of the fact that Wall Street loves bigger, better things with potential future growth output or opportunity, but it's also because, let's face it, they've done an incredible job of either increasing revenues on a regular basis, which Wall Street will fall in love with regardless of profitability, for that hope that it eventually becomes profitable, or they've had eventually made that transition to where they've had a rapidly increasing amount of profitability. And both of those things could be under significant pressure if we start going into a change in this economy. And I think, to me, that is, I think that as much as we fall in love with these names, they've now become mature. And when you start to be, when they start to become mature, they start to have, face more, corporate arthritis. Let's put it that way. They've got to face real big boy problems with regards to maintaining that excitement and that energy. If Apple can't continue to innovate and come out with a better phone, I'm already hearing it. There's already people that have been longtime Apple users saying, yeah, it's the same phone again, over and over with just new bells and whistles. That is not what got Apple to this point. And eventually the love for them will dull if they can't continue to innovate. So not only is it going to be expensive to produce it, but they've got to keep getting people who are going to afford it, and they've also got to keep the excitement up. So, just I think it's really interesting. I love the breakdown of those charts and to see where that is, and you can start to see where, if we go into a recession, why there could be some real problems for some of these companies. Now, one thing that Microsoft does have going for them, which is a good thing, they're very invested in AI, and as everybody knows, AI seems to be a place that a lot of people are heading. And even if we get into a recession, AI may do well, because guess what? If we're doing layoffs, if we're reducing headcount, someone's got to put out the information, and AI is basically free labor. So, it's going to be interesting that we're in a changing world there. The day of singularity is coming. I talked about it earlier. Costs are going up. I'm going to say with a couple minutes we have left here, if you have any questions or concerns about the impact of this economy on your business, if it's already something you're trying to grow and you see the reasons to be more efficient and effective in the way you run your business, and ultimately you'd rather run your business and have the business run you, go to automaticbusinessmethod.com, download the free checklist, 9-step process to immediately improving the valuation of your company, immediately improving the automation of your company, immediately improving and the way that company works for you versus you working for that. And if you're a family that is planning for college, it's never too early to start. I don't care if you have a 2-year-old. I don't care if you're planning someday to have a 2-year-old. Listen, start saving. There are different strategies. 529s, they're trying to funnel you into that business of 529s. They're okay. Nothing wrong with them. But it may not be the right way for you to save if you think about the future. And if you've got a child that's already entering high school, you've got to think about the best way to save money is the selection of college. Go to ProCollegePlanners.com. Get the information you need right now. It's free to learn how to start this journey and pick the right college that's the right fit for your child.
Great. Well, Doug, thanks for coming on the show. And I want to end off with one quiz for Doug and also an absurd thing that'll make you think. So, Doug, I'm going to put this up here. This is a company, and I wanted to kind of put this up here, and I'm not going to tell you which company it is, so Doug's not aware of this. The average recommendations a hold, the average price target is $44.83. The number of analysts are 17. Last quarter's earnings are $1.23. Year ago earnings were $8.15, and the current quarter's estimate is negative 99 cents. And I'm going to give you the most important information, which is currently the stock is around $6. So, we want to guess what company this is? I know it's a big question.
I kind of want to go back to one of the meme stocks, a stonk. $6 a share should put me in a different direction, Kirk. I'm struggling with this one. It's not best. It's not better.
It's a bank.
It's a bank. Oh, okay. First Republic.
You got it.
There you are.
Get the prize, Doug. You got the prize. So I pointed this out, and Doug's you're clairvoyant. You must be really sharp, Doug, because this is First Republic. Now I point this out not to point out First Republic, but to point out why you don't follow Wall Street analysts. So Wall Street analysts, there are 17 of them. I'm not going to call them by names. There's 17 of them on average. And not all, I don't know if all of them have this, but on average, their price target is $44.83. Currently, the stock is trading at $6. And there's a question of whether it'll even survive, right? Because they're talking about Fed bailouts. I saw something in the news that maybe over this weekend they might take them over. I don't know what's going to happen. These are all rumors. Point being is First Republic is not in good shape. Yet, on average, 17 really, really smart people have put out a almost $45 price target with a stock trading at $6. Oh, and their average recommendation's a hold. So what's wrong with this?
Let me address that really quickly, Kirk. Given the circumstances of First Republic, do nothing is not an option. Okay. Now, I could see a sell recommendation. Get out before you lose everything. Heck, I could see a super speculative analyst saying it's a buy recommendation. Look at the value. Do nothing makes absolutely zero sense.
Yeah, but just think of the disconnect. And I want to end with this bit of humor here before I have the absurd things to make you think.
Wait, you haven't said the humor yet? I'm sorry.
Oh no, there's an absurd thing to make you think that comes after this, which will make you. I mean, maybe I should just end with this. I mean, this in itself is pure comedy. So what it should be, if an analyst is making a recommendation, there's a hold, which is I'm neutral on it. There's a buy and a strong buy. And then there's a sell and a strong sell. Those are the traditional. Every firm has their own little derivative of that, but there's basically 5. The one in the middle is, just hold on. So we're not saying sell it, but we're not saying buy it. So if you own it, just hold on. That's how it should work, right? And you would think that at that time the price target would be approximately around where the price is now, right? If your price target is $44.83 and the stock's trading at $44 or $45, it's a hold, right? That makes sense, right? total sense. It's around the price target, so you don't need to buy, you don't need to sell, whatever. Um, but if I saw this in any other circumstance where the price was $6 and a price target is almost $45, that's not a strong buy. That's a WTF are you thinking? Get in the stock now, buy. I mean, this is crazy numbers. So either one of multiple things have happened. Either the analysts got laid off and nobody bothered to update the ratings. That's one scenario. I'm not calling that out. It could happen. Wall Street is having layoffs. Another thing that could happen is they somehow had a bug on their sheet. 17 of the sheets had a bug on it, and they somehow maybe they got a digit off, right? Maybe the decimal place is in the wrong place. But to have the fact that is such a discrepancy of price and price target and the recommendations is absurd. It's absolutely, and the fact that it's a hold, and on Wall Street, a hold means a sell, by the way. If you see a hold, it really means a sell. There might be like, I don't know, 100 Wall Street firms. There might be one sell out of thousands of companies in the whole industry. There might be one sell recommendation. When I was at Payne Weber, I think there were 4. Out of like 5,000 companies, there were 4 sell recommendations, none strong sells. That should tell you something, right? It should tell you that there's a real problem. And by the way, this was in 1999 when tons of companies had negative earnings and companies went bankrupt left and right. There were only 4 companies that were a sell. So I just point this out because if you're following Wall Street recommendations, don't.
Yeah,
You just shouldn't.
I'm gonna tee on that because I'm looking at a fairly reputable research group, and I'm not going to use their name here. Their long-term 6 to 12 recommendation is underperformed. Their short-term 1 to 3 is a hold, with a value being a grade B, growth being a grade D, momentum being a grade F. Surprise, surprise. But when you get down to the actual summary of their analysis, it says reasons to sell, reason 1, reason 2, reason 3, reason 4. Then it lists the risks 1, 2, 3, and 4. Then it goes in the last earnings report. What did I not hear anywhere on that screen? The reasons to buy. It's not even listed, but yet it's considered a hold. There's your example, perfectly it laid out perfectly. I do not understand it.
Yeah, I saw this actually just come by me, which is why I put it up last minute, and Doug didn't have a chance to see it. It just came up on my feed, and I just started laughing to myself. So just something to think about. And look, I don't know what's going to happen to First Republic. I don't care. I don't own it. I'm not even looking at it. And if you don't own it, don't even bother. But the point is you have stocks like this. There's a huge disconnect. Sometimes it could be timing, could be all sorts of reasons. Maybe they can invest in banking business. Who knows? Point being is don't follow Wall Street research. It's garbage. If you actually don't want to listen to me, if you think I'm just blowing smoke, there's a great book called Full of Bull. I read it in around 2001, and it's an institutional analyst who won like many years in a row, won like the best analyst on Wall Street award like multiple times. Like the guy is not just some crackpot that's screaming that the sky's falling. Here's a guy who wins awards every year. He wrote the book called Full of Bull, which is basically Wall Street analysts are full of bull. And he called out the whole industry, why it works, how it works. Highly recommend the book if listeners want to learn more about this. It'll give you some great insight into Wall Street. Now, granted, Wall Street has changed a little bit in the last 20 years, but not a whole lot. So just something to think about. And I'm going to leave you with one last absurd things to make you think. And here's another funny one. So Harvard University employs 7,024 full-time administrators, which is only slightly fewer than the undergraduate population. Think about that for the moment. You almost have a 1-to-1 administrator to undergraduate ratio.
No, I want to make sure you're clear. You meant they have 1-to-1 professor to student ratio, right? The people that are in there working with the students and teaching them?
Administrators.
Of course.
No, professors actually have a job. Their job is to teach, right? Administrators' job is to, I don't know, find work to administer. I'm sure there are some administrators listening to this, so I don't mean to knock it, but the fact is There shouldn't be 7,024 when you have approximately when you have a little bit more than that in undergraduate population. I bring this up because
I think that college is built to make money, to spread the wealth internally to those that own and run the college, you are completely mistaken.
It's a nonprofit though, Doug. They shouldn't be making a profit. Maybe this is why they don't make a profit. Hospitals are the same way. Hospitals are run very much the same way, where they're filled with administrators. And what comes to mind is a scene. If anybody's watched the movie Wall Street, and hopefully you all have, if you haven't, you need to watch this movie, even though it's decades ago. It's brilliantly done. Where this scene where Gordon Gekko is in Teldar Paper annual shareholder meeting, and you got a bunch of like VPs up there, and he's just ripping them a new one about how they're just screaming like they're just burning money. And he's saying maybe all the money's getting burnt because there's all these VPs, and he kind of like tears it up. He's like, what are all these VPs doing? They're just exchanging paper with each other. I mean, it's a great scene, and it's very well done as an actor. But the point being is like at some point, you just need to have fewer people in operations and administration. I'm sorry, if you're in a for-profit company, have as many as you want. If you're in a nonprofit, you don't need that many administrators. So,
and that's really the thing. I think it's just a good lesson for people to learn is they see nonprofit and they think, oh, charity, right? And there are sites out there that you can go and X-ray the internal workings of nonprofits to realize what's going on there. Nonprofit just means they cannot not account for a distribution of any revenue that they bring in. Where they distribute that to leaves a lot of wiggle room, right? So they don't pay taxes, they can't have profit, which means that many nonprofits are built for the exact purpose of paying people a lot of money.
Yep. Well, we're going to end on that note. I would have preferred to end on the comedy, but that should make you cry, not laugh.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.